Rezolve AI, trading under the ticker symbol RZLV on the Nasdaq, is currently trading hands at exactly $2.54 per share, showing a downward pressure of roughly 2.16% to 6.9%, depending on the exact intraday swing we are looking at right this second. The volume is heavy, significantly higher than its average, with over 16 million shares traded already, indicating that the market is violently trying to reprice this company in real time. If you look at the chart, you might see a stock that has taken a beating recently, dropping sharply after a major announcement, and the immediate instinct for most retail investors is to run for the hills. The expectation here is simple and brutal. A small-cap AI company just spent a lot of money it doesn't really have to buy another company, loading up on debt, and the market is punishing them for it. That is the standard narrative. It is the easy story to tell. But the reality is far more complicated, and frankly, much more interesting. What you are actually looking at is not necessarily a company drowning in ambition, but perhaps one of the most aggressive arbitrage plays in the AI commerce sector we have seen this year. The market sees a debt load. The smart money might be seeing a company that just bought $70 million in revenue and a massive enterprise client list for pennies on the dollar. This disconnect between the scary headline and the underlying math is where we need to focus our attention today. Let's get into the specifics of what is driving this price action, because it is critical to understand the mechanism before you make a decision. The massive volatility we are seeing, the stock is down significantly from its 52-week high of $8.45, is almost entirely driven by the announcement that Rezolve AI is acquiring Crownpeak. Now, on paper, this looks like a minnow swallowing a whale, or at least a very large tuna. The deal is valued at roughly $240 million when you factor in the debt assumption. For a company of Rezolve's size, that is a staggering amount of leverage to take on. The expectation from the street was that Rezolve would grow organically, signing up retailers one by one for its brain-sweet technology. The reality is that they just skipped the line. By acquiring Crownpeak, they didn't just buy technology, they bought a customer base that includes Sephora, Tommy Hilfiger, and Calvin Klein. They effectively purchased the distribution network that would have taken them 5 years to build on their own, and they did it in a single signature. The market hates uncertainty, and this deal introduces a lot of it: integration risks, debt servicing, and dilution. But if you strip away the fear, you are left with a company that is projecting to exit 2025 with $160 million in annual recurring revenue. If you apply a standard software multiple to that number, the current stock price of $2.54 starts to look less like a warning sign and more like a mispricing. To understand why this matters, you have to look at what Rezolve actually does, because it is not just another AI wrapper. Most people think of AI and retail as those annoying little chatbots that pop up in the corner of your screen and give you generic answers. That is the expectation: low utility, frustrating automation. Rezolve's reality is different. They have built something called the Brain Power Engine, and specifically a feature they call the Zone of Truth. This is crucial. The biggest problem with using large language models like ChatGPT for retail is hallucination. If you ask a standard AI about a product, it might invent features that don't exist, which creates legal liability for the retailer. Rezolve's architecture restricts the AI to the retailer's specific data set, its inventory, its return policies, its shipping data. It forces the AI to stay within the zone of truth, ensuring accuracy while still allowing for natural conversational interaction. This solves the hallucination problem that has kept major brands from fully adopting generative AI. With the Crownpeak acquisition, they can now deploy this zone of truth capability instantly across Crownpeak's 400-plus enterprise clients. They don't have to pitch the CIO of Sephora cold, they are already in the building. That is a massive strategic advantage that the current red candle on the chart is completely ignoring. We need to talk about the leadership here because it adds a layer of personal stakes that you don't often see. The CEO, Daniel Wagner, actually founded the company that originally built the product discovery technology Crownpeak uses. For him, this isn't just a business deal, it is a homecoming. He knows the code, he knows the clients, and he knows exactly where the inefficiencies are. This reduces the integration risk significantly. Usually, when Company A buys Company B, there is a period of 6 to 12 months where nobody knows who is doing what and productivity falls off a cliff. In this case, the acquirer built the asset he is buying. This nuance is lost in the algorithmic trading that is hammering the stock right now. The algorithms see debt increase and cash outflow, and they sell. They do not see founder reclaiming his legacy tech to supercharge it with AI. This is where the human element of investing gives you an edge over the machines. You can interpret the qualitative data that the quantitative models miss. Let's pause for a second and look at the broader sector context. We're in a phase where the initial AI bubble euphoria is fading, and investors are demanding real revenue. The market has punished companies like C3.ai and even pulled back on the Magnificent Seven at times because the question has shifted from "what can you do" to "how much money are you making right now?" Rezolve's move to acquire revenue, real hard cash flow from Crownpeak, is a direct response to this shift. They aren't waiting for the AI revenue to materialize out of thin air. They are buying a cash flow positive chassis and bolting their AI engine onto it. This is a very different strategy than the growth at all costs mindset of 2021. It is a survival strategy for a high interest rate environment. By securing $70 million in revenue from Crownpeak, they buffer themselves against the volatility of the pure play AI market. If the AI adoption curve is slower than expected, they still have the subscription revenue from the digital experience platform to keep the lights on. It's a hedge, and a smart one, even if the market is treating it like a liability in the short term. Now, I want to hear from you guys, because this is a polarizing stock. Comment below how many shares of Rezolve AI you currently hold, or if you are waiting for the price to drop even further before you start a position. Do you think the debt they took on for Crownpeak is a masterstroke or a mistake? Let me know in the comments. Moving back to the technicals, the stock is sitting in a very dangerous but potentially lucrative zone. At $2.54, we are hovering near historical support levels, but the recent drop has broken through several moving averages. The RSI is likely screaming oversold on the daily chart, which often precedes a bounce, but you cannot trade on RSI alone when there is a fundamental catalyst like a merger involved. The volume we are seeing, over 16 million shares, tells us that capitulation is happening. Longtime holders who got in at $5 or $6 are throwing in the towel. They are tired of the volatility. But capitulation is often the dinner bell for institutional value investors. When the weak hands fold, the strong hands start accumulating. If you look at the order flow, you might see large block trades coming in amidst the sea of small retail sell orders. That is the smart money absorbing the liquidity. They are buying the fear. Let's discuss the Brain Suite in more detail because this is the product that justifies the entire valuation. The suite includes Brain Commerce, Brain Checkout, and the Brain Power LLM. The Brain Checkout feature is particularly clever. It allows a consumer to go from "I want this" to "purchase complete" in a conversational flow without clicking through 10 different pages of forms. In the mobile commerce world, friction is the enemy. Every extra click drops your conversion rate by a significant percentage. Rezolve is attacking this friction directly. By enabling instant checkout within the conversation, they are directly impacting the retailer's bottom line. If a retailer installs Rezolve and sees their conversion rate go from 2% to 3%, that pays for the software 10 times over. This is the ROI argument that they are taking to the market. It is not about AI is cool, it is about AI makes you more money today. The Crownpeak acquisition gives them 400 new sandboxes to prove this thesis. If they can convert even 20% of Crownpeak's clients to the full Brain Suite, the revenue synergies will be explosive. However, we have to look at the risks with clear eyes. The expectation is integration goes smoothly. The reality of M&A is that it rarely does. There could be culture clashes, key talent could leave Crownpeak, or the debt service costs could weigh heavily if interest rates stay higher for longer. Rezolve has assumed roughly $150 million in debt. For a company with a market cap under $1 billion, that is a heavy anchor to take on. If they stumble, if they miss a quarter, or if the Crownpeak revenue degrades, that debt becomes a noose. This is the bear case, and it's a valid one. You are betting on execution here. You are betting that Daniel Wagner and his team can integrate these two businesses faster than the interest payments can drain their cash reserves. It's a race against time. The stock price reflects this anxiety. It is pricing in a significant chance of failure. But that is also why the upside is so high. If they succeed, the stock is mispriced by hundreds